Well, short-term disability benefits are usually the first benefits that you would claim if you have that coverage available through your job. Not every employer has short-term disability benefits, so where there isn't any, you might go on to something like EI, which is employment insurance sickness benefits as an alternative. But if you have short-term disability benefits, you would have to apply to those first. And the difference between short-term and long-term is that very often the short-term benefits are paid by your employer either through payroll at some lesser amount, or perhaps it is a full replacement of your salary for a period of time. But very often it is administered by a third party, which could be the same insurance company as would pay long-term, or it could be an independent manager of disability benefits that your employer hires to look after short-term to provide some sort of confidentiality or privacy with respect to your medical condition, and only providing details on a need-to-know basis only. So that is the main difference between those two types of benefits. Short-term disability kick in either from the date that you are disabled, or sometimes there's a brief waiting period, sometimes like 7 days. The maximum period for short-term disability benefits is usually somewhere from 3 months to about 6 months. We have seen cases where short-term benefits go on for a period of about a year. It is usually equivalent to the elimination period or waiting period to start receiving long-term disability benefits. And one of the preconditions for qualifying for long-term benefits is being found to be totally disabled throughout the short-term disability period. It varies from plan to plan. So if you have short-term benefits, you probably want to take a close look at what information you've been provided with, either by way of the policy or a booklet or some other kind of summary provided to you by your employer. Very often where it's employer funded, it can be based on years of service. So if you've been working at the company for a number of years, you may be entitled to a slightly higher rate of short-term disability benefits than if you've only been there for a short period of time. And with respect to the amount that you can expect to receive, as I said, it sometimes can be as much as 100% of your pre-disability base earnings. Very often it's a percentage, and sometimes that percentage is higher than what you might get for long-term disability benefits. It's a much shorter duration, so from a financial point of view, the employer is not as concerned because it's not a 10-year entitlement. It's usually something less than a year, and usually not more than 6 months. So it's a much more restrictive type of an exposure to the employer for paying out those types of benefits. Well, much like applying for long-term disability benefits, there are forms that have to be completed. There's usually a form that you, as the claimant, would have to complete, describing the reasons you can't work and some of your medical history, work experience, and the like. There's a form that may have to be completed by your employer, depending on how that works internally there. And you will have to provide medical evidence, usually through a document called an attending physician statement, which is often very similar to the form that is required for the long-term disability benefits. One other important thing to bear in mind, if you've only been working at a very short period of time for your employer, short-term disability benefits are not generally subject to a review for a pre-existing condition exclusion. So you may still be able to get short-term disability benefits, even if you might not be able to get long-term disability benefits if you have a pre-existing medical condition that might exclude you. So that's something to bear in mind if you're making an application for short-term disability benefits. Well, long-term disability benefits initially are pretty much what they sound like. They're meant to cover a longer period of disability than merely a short-term disability, which is usually not more than about 6 months, in some cases longer, but it's short-term, meaning it doesn't go on for years. Long-term disability benefits may cover you for an extended period of time if you're not able to work either initially from your own occupation or any occupation, depending on the severity of your illness or your disability. In many cases, long-term disability benefits usually can go as long as to age 65 and sometimes longer, depending on the specific plan or policy. But if you are, say you're 50 years old and you have a very severely debilitating medical condition that prevents you from working in your own job or any job, you may be able to stay on disability benefits until usually age 65. Long-term disability benefits will only cover a portion of your base salary usually, and whether you're earning commissions or some other type of supplementary income or bonuses, it usually doesn't cover that. There are exceptions to that as well, so it's important to read the fine print. In terms of the amount, historically it was usually something like 2/3 of your income or salary. Over time, formulas have become more complex, and we often see coverage for say 70% of the first $2,500 a month that you may be entitled to, and then tapered down to a much lower percentage with a certain maximum. So it's important to have an understanding of how much you might be entitled to receive if you put on a claim, or when you're negotiating coverage, if you have the option to do that. Most people in a job interview don't really have an option to negotiate it, but it's important to understand what it is you're entitled to receive if you become disabled, to determine whether that's going to be enough for you to live on. Well, you need to have medical support. There's forms to complete, much like in short-term disability benefits or any type of insurance claim. There's forms that have to be completed by you, by your employer if it's a group benefit, and by your doctor, an attending physician statement setting out the nature of your medical condition and why it prevents you from working either in your own occupation or any occupation. Obviously, you have to have coverage. If there was a requirement to be paying into the plan and paying premiums, you have to have been doing that. So if you hadn't been, your coverage may have lapsed. So it's important to be doing that. And then one of the other eligibility requirements is usually the requirement to be able to establish that you were totally disabled throughout the elimination period or waiting period. Whether or not you had short-term benefits or not, you still would have to show that you were totally disabled from working during that period as well. So it is true that most group disability policies have something that we refer to as a change of definition, and it usually kicks in at 24 months. It can sometimes be as little as a year, or it can be longer than that depending on the policy, but the most common one we see is 24 months. And the test during the first 24 months is essentially that you're unable to perform the essential duties of your pre-disability occupation, whether at your place of employment or any other employer that might employ you for that type of occupation. After 24 months, the test changes to what is referred to as the any occupation test, and the wording may differ from one policy to the next, but in essence it is an inability to perform the essential duties of any occupation for which you have the requisite education, skill, or experience. From a practical point of view, that any occupation test really is whether you can work at something that would pay you a commensurate amount of income compared to what you previously earned, or earning at least enough to knock out the long-term disability benefit. Obviously, each set of circumstances or case needs to be reviewed separately, but those are the general principles. The money usually is paid directly to you by the insurance company if it is an insured benefit. What that means is that if it is in fact an insurance plan or policy that's been provided, then you're being paid by that insurance company. There are some exceptions to that. There are some places of employment that have the employer paying it and having it managed by an insurance company. So you might be dealing with a large insurance company and have no idea that the money is actually still coming to you from your employer, because it's not it's not really described or explained very well to most people. There's also a possibility that you may be getting benefits from something called a benefit trust, which means money is being gathered if you're through a union or something of that nature, where the money is paid into a trust fund and then administered also by an insurance company. So that's not actually coming from your employer, that's coming from monies that are put aside like a pension plan to pay long-term disability benefits. So those things are important when we have a denied claim and trying to figure out who it is that we have to include in any legal action to recover your benefits. It can become quite complicated and confusing, not only for you as a person trying to recover your money, but even for your lawyer to try and figure it out, because we don't get a lot of cooperation from the insurance company or the unions and the employer to try and figure that out. We have to try and figure it out by gathering information.